everyone, and welcome. We're delighted to have you join us today. My name is Laura Sebesta. I'm Principal Client Relationship and Business Development Manager at FGP. And today I have the pleasure of being your moderator. Before we get started, just a quick note. Today's discussion is being recorded so that we can share it with those who couldn't attend live. We'll also save time for your questions at the end. So if you think of anything as we go, please jot it down. As we all know, markets have been anything but predictable lately. It's in times like these that choosing the right investment partner matters more than ever. Today's discussion is not only about what the markets are doing, but who's guiding you through them. At FGP, we believe our edge lies in our consistent and disciplined investment approach, rooted in quality and value, and a culture of client service and long-term alignment. I'm joined by two of those individuals who embody our philosophy every day. Brian Pillsworth, President, CEO, Portfolio Manager, Canadian Equities. Hi, Brian.
Hello, Laura.
And Ryan Domsey, Executive Vice President, Portfolio Manager, and Head of Fixed Income. Hi, Brian. Today, we'll explore the current environment, how we think about opportunity, how we think about risk, and how we strive to align with your goals and values. Before we dive into the discussion, we'd like to do a quick audience poll. It's a great way to hear what you're thinking and set the stage for the conversation ahead. So if you could pull out your phones and open up your cameras, we ask that you please scan the QR code on your screen and respond. Once you've made your selection, your response will be automatically submitted. So the questions are, what do you see as the biggest risk to markets over the next 12 months? Inflation staying sticky, a recession or growth slowdown, geopolitical tensions and trade disruptions, policy missteps by central banks, or something else entirely? Surprises are the real risk. I'll give everyone a few moments. It's always interesting to see what's top of mind for investors, and these results are a good reminder of why disciplined long-term approach matters. So it looks like recession or growth slowdown is in the lead, and closely followed by geopolitical tensions and disruptions. But at any given moment, there's a multitude of unknowns. So I will now turn it over to Brian and Ryan to share how we're thinking about the current environment. Ryan, let's start with you. Canadians have been navigating shifting tariffs and trade policies for most of this year. What's your economic perspective, and how are those forces shaping how you view rates?
When we think about the economy and investing, one thing that's always present is just a large degree of uncertainty. But what exists right now is an excessive amount of uncertainty. We have really unimaginable or previously unimaginable trade disputes, potential for tariffs. And what's interesting about this is it just creates a lot of that uncertainty that we speak about. The impact that has on the fixed income market, on portions of it, is somewhat certain. On other parts of it, still leaves a lot up in the air because of the way it's being rolled out. What we do know is that when we see tariffs, we eventually will see inflation. You can't apply tariffs without having some sort of inflationary impact because you're naturally increasing prices of goods. And so that's something to keep in mind. But at the same time, all the uncertainty causes businesses to likely reduce their current investment. The reason being is that there's a lot more uncertainty about how their financial projections and the quality of different projects will look depending on the different political decisions that are made on the tariff and trade front. And so that's something that is a continuous drag on the overall economy. And so if we're seeing a weakening real economy, what does that mean? Well, what that means is that we're seeing an impact in growth, we're seeing slowdowns in growth, and we're seeing slowdowns in the labor market in somewhat interesting ways. When we bring that back to fixed income, we can say that some parts of the market are clearly overvalued. I think in this chart, if you look on the right, we see a blue line and a gold line. The blue line is corporate credit spreads. The gold line is provincial spreads. What's very clear on that is that, versus the last decade, spreads are at exceptionally tight levels. What does this mean? It means there's not much of a margin in safety in spread investing at the current point in time. When we look at rates, that's much more uncertain, right? As I said, we have different forces going on, right? There's inflationary forces, and inflationary forces could actually slow the economy, which would make us think that rates should go lower. But at the same time, depending on how that plays out and how much the economy slows, the inflationary forces actually could lead to lower real rates, but higher nominal rates, depending on the breadth and level of tariffs that could end up being around, and also the persistence of those tariffs, right? If they're put in place and left there for a long time, the impact's much more, and you'll see a larger divergence between real rates and nominal rates. And so in that case, if nominal rates go up, you would see the chart on the left actually start spiking. But in a traditional slowdown, you would actually see that chart come down. That produces two very different environments for the movements of bond prices. I think that when we think about Canada and the impact that this current environment has on our economy, it's definitely weakness, right? We need capital investment. We need people spending money, and that doesn't happen to the same degree in an environment like this. What we definitely need to see is a shift to more economic independence, incentivization to domestic investment, as well as reduced trade barriers, especially internally. Those are easy wins. And so that's kind of where our framework is for the economy and the fixed income markets.
Thanks, Ryan. That was an excellent overview of how these forces are playing out on the fixed income side. Brian, from an equity perspective, how are you thinking about these same macro forces, in particular, the renewed focus Ryan highlighted on economic independence here in Canada, and what types of companies perform well against this backdrop?
That's a big question. There's lots to explore on that. So I think just in general, from an equity perspective, when we think about the economy, we try to understand, obviously, if there's inflation, that could potentially mean higher long-term interest rates. What impact do interest rates have on the companies that we own, like a bank or an insurance company or a company that's just borrowing a lot of money? So what we try to do, and I will give a few thoughts on the Canadian economy, but in general, what we're trying to do is to take the macro inputs for each of the companies and then do scenario analysis. So if interest rates move higher, that long-term interest rates move higher and there's a steepening of the yield curve, that's generally better for the banks because they are a spread business. So that's how we use the inputs into it. It's funny, I was meeting a client and they said, how is it possible that the Canadian stock market has done so well relative to a weak economy? And I said, well, the reason that you've got this contrast and paradox is that certain pockets of the Canadian stock market, the stock market is not the economy as a general rule. There's major differences between the stock market and the economy. But if you drill into the TSX, the stock market, materials have had a pretty decent, in general, materials have done very, very well. So a lot of material companies have done quite well. Not surprisingly, some of the precious metal companies have really done well. And then other pockets of the company, like the financials, they have actually had, revenue growth and some degree of earnings growth as well. So that's helped as well. So they're just because the economy looks potentially poor doesn't necessarily mean the stock market's going to do poorly as well. Now, looking forward in Canada, because you were kind of hinting about, our economy, and Ryan was talking about some of the things that would be beneficial for the Canadian economy. It's clear that we're going through a period of transition right now. There's no doubt about it. And there's a lot of ebbs and flows. It's difficult to make broad sweeping generalizations about what you think the economy is going to do to a specific company. I'm just going to give you one example. Canada has a number of car parts companies, and when the tariff announcements first came out, back in April, there was a kind of a broad conclusion that the Canadian car parts companies were going to be quite negatively impacted. Cars weren't going to cross the border. And over time, what we learned is that, cars were still being manufactured in Canada and moving to the US, and they were actually going tariff-free, believe it or not. The valuation of a company is very important because that the valuation sometimes gives you the opportunity, and I'll talk a little bit more about that later. But needless to say, the initial view was that the car parts companies were going to get damaged. But what we've subsequently learned is some of them have said, well, things are still crossing the border tariff-free. And then, oh, guess what? We're getting opportunities actually as a result of some of these tariff actions in the United States to build new plants in the United States because car company A no longer wants to import the part from potentially Europe. Sometimes things look very dire. And you've got to be flexible enough to realize, well, maybe there's offsets, maybe there's other positive things. So wrapping this back up to the trade tensions that we're having right now, it's very difficult to predict right off the top that something is going to be absolutely great or something is going to be absolutely terrible. You have to be flexible and say, okay, what are the offsets? You want companies that are adaptable to the environment. So regardless of whether it's great times or poor times, they can adapt, and we'll explore that a bit more later.
That's a great point, and I think that gives us a strong sense of how you're both interpreting the macro picture. Let's talk about how that translates into practice. Our philosophy is rooted in investing in quality businesses at reasonable valuations. How do you define a quality business?
Yeah, so I think a quality business, and Ryan, I'm sure you're going to opine about this as well, but we look at things in a similar way. A quality business is a business you can understand that has a predictable business model. You know how they make money today, and you know how they're going to make money a decade from now. I think that's a key component. So understand the business. It's a business that you know how it's going to be profitable in the future. Number two, it's a business that is well run. There's different quality management teams, and a great management team can navigate through tough times. They're very good. Even if the market's going down, they can figure things out to do better than the market. So I think that's number two. A quality business is also one that has a reasonable balance sheet. And this is very important in tough times because if you have too much debt, that's a problem. If you have your interest payment, which is fixed, and your revenue lines coming down, that's pressure. So you want companies with good balance sheets. Even though we're talking about quality, you want to be able to buy these businesses at a reasonable valuation. That's very, very key as well. So those are kind of the things that we look at. A business we understand that's got a predictable business model in the future with a capable management team and also with a balance sheet that's not over-levered that gives us excess risk. And that's how we view it.
Can you give us an example of one in the portfolio?
Yeah, so I always have to, my chief compliance officer is right here, so I have to give the usual caveats. You need to do your own research, but I will talk about, I'll just give you one example. I mean, a company that we own right now is Finning, and Finning is the world's largest Caterpillar dealer. So they have operations in Canada, in the United Kingdom, in Argentina, in Chile. And the beautiful thing about this business is they sell these massive Cat trucks, and guess what? They need servicing for decades. So this company actually gets more revenue from servicing the product that they sell than the product itself. And if we can buy a business at a reasonable valuation where we know for the next 2 decades there's going to be a service contract to sell parts and do overhauls and refurbishments at attractive margins, that's a great business. I know how they're going to make money in a decade from now. But you got to be careful about the valuation.
That's a great example of quality in the context of equities. Ryan, does this definition of quality extend to the fixed income market as well, or fixed income as well?
Yeah, for the most part, I think it does. I think when we think about quality, one of the major things that we think about in fixed income is that we need to understand how a company makes money today, but also why they make money today. And as Brian mentioned, why they're going to make money in the future, right? What sort of moat do they have that protects their business, protects their revenue streams to ensure that, 10 years from now, 20 years from now, they're still going to be able to make money, in particular for us, make money to repay our debt. We're not hoping for higher stock prices. We actually have a financial obligation that we need to either have paid back or have some way for them to refinance in the future. two businesses that are very unique that would exist in the fixed income space, but definitely not in the equity space. That I think embody an easy understanding of how how a business makes money would be Nav Canada and Terranet. Nav Canada operates a civil air navigation service for Canadian controlled airspace. It's a really interesting business model because it's not a stock-based company. It's a non-share capital corporation legislated by the government into being. And with that comes a bunch of rules of how they need to operate. Why this is so great is that they make money from air traffic. And some people would say, well, if air traffic goes down, then they're going to make less money. But they have a rule in their legislation that if air traffic goes down and they make less money, then they have to raise their fees. Their fee is nominal relative to overall airline costs, which are obviously quite high and keeping on increasing. So there's a lot of room for them to increase their fees to quite dramatic levels before they would actually have then an impact on additional market demand. So it's very clear, less air traffic, they raise fees, they make the same amount of money because they raise fees. Air traffic goes up, they actually lower fees, still make the same amount of money. And so as a bondholder, that's a very unique business model, and it's a business model that, assuming spreads are good, can provide a great opportunity for investment. There's a great moat to that business because there's government legislation that makes sure they charge fees and generate revenue, right? And as we've seen with our government, it's very hard to change policies. Not so much in the US, they change policies all the time nowadays. But in Canada, it's very difficult to get buy-in to actually change policy. Terranet's another interesting one, right? It's actually owned through the OMERS conglomerate. It's an interesting business, again, because it has a monopoly on all of the registration database activity for housing and writs. Property and writs in Ontario. They also have a business in Manitoba, but the business is almost entirely, the revenue from the business is almost entirely Ontario-based. That's really unique business, again, because every time a house is registered, every time a writ is registered or applied, they collect a fee. Right? Every time a search happens, they collect a fee. Some people would say, oh, but when the housing market slows down, they're no longer getting fees anymore. But that's not true. That's a portion of their revenue. And it's a meaningful portion, but that doesn't have a massive impact. And the reason being is that every time someone refinances a mortgage, unless they're rolling it over under the same terms with the same lender, they have to do a new registration, right? You buy and sell a home, that's 3 registrations. You get divorced, you have to take someone off the title of your home, that's another registration fee. Not one people like to think about, but regardless of how housing activity works, divorces and deaths still happen and someone needs to change the registration. And so this business has an incredibly stable business model, right? Not much growth. The parcel base barely grows. You're talking 1% to 2% per year. Probably less this year because I don't think as many condos are going to be brought online. But it's very stable over time. And again, as a bond investor, that's what we're looking for. And so it's businesses that quality means to us an understanding of how they make money today and how they're going to and why they're going to keep making money in the future.
It's great to hear how consistent that quality mindset is across the asset classes. I'd like to build on that idea of alignment and quality. One of the differentiators at FGP is our owner-operator culture and mindset because many employees are shareholders. How does that internal alignment influence your day-to-day decision-making or how you think about long-term positioning?
Yeah, so you touched on a great point. I think there's a couple key things to cover off here. First of all, we are owner-operators, so it's very important for us to have a long-term perspective. And when you're an owner of a company, you think long-term. You don't think in terms of quarters or years. You're thinking in terms of decades. And it's really, we know that when our clients are successful, we'll be successful. So you've got to take that perspective. I think that's number one. Number two is that we are also very much aligned with our clients because we are invested in these funds. I always kind of make the joke, but I'm dead serious. You know, my in-laws, my mother, my family, friends are invested as clients. So we're all in the exact same thing. And we're invested in these, whether it's a balanced fund or some of the standalone products for retirement. And so when you're thinking of retirement, you think of the long-term compounding, and compounding is so important to creating wealth over time. So you have to have a long-term mindset in this business. And I think that we've got that structured very, very well. And the last thing that I just want to mention is that when we hire and bring people into the firm and the philosophy, we try to bring in people into our firm at junior levels and develop them over time. And if you look at our teams are very stable. We've worked together for a long time, but we really take a long time to develop people, and we've got a secret sauce that people actually been with the firm for a very long time, and that creates this long-term perspective in teaching the investment philosophy and applying it over time. So I think those are all key things to our magic.
Those are great points on long-term thinking and alignment. Ryan, I'd like to turn it back over to you. Credit risk is central to fixed income. How do you assess credit quality, and what are you selectively favoring or avoiding today?
Yeah, I think to start off, long-term alignment is actually very important in credit analysis. I think something that we speak about quite frequently is that many investors rush to make a decision. We'd rather miss out on a potential opportunity if we don't feel like we understand it. Like I said, we need to understand why and how a company makes money, why they will in the future before we're going to invest. And so if we can't get comfortable with any aspect of their structure, then it's not aligned with us, right? We'd rather miss out, but make sure that our clients don't lose money. In fixed income investing, it's easier to take that approach, I believe, because missing out on an opportunity might be marginal, where in our view, making an investment in something where you potentially don't have enough information or aren't comfortable with it can create a big problem in your portfolio. If you lose money in fixed income, it's quite serious. Making up for that is hard. We don't have the ability to have our companies get bought out at a massive premium. And so for us, when we need to catch up from a mistake, you then need to make a ton of exceptional investments to get that outperformance back. And so for us, the easier way to do it is to just try and not make a mistake. It's not that we never will, it's that that's the goal. And so for us, we'd rather sit back, take our time with credit analysis, make sure that we understand something, at least that we think it's understand it fully before we'll execute, right? We don't want to rush it and potentially make those big errors. I think when we're actually doing the credit work, the foundation of how we do that is to really understand the industry that a business operates in. We need to understand how a specific business or participant is situated within this industry, right? Depending on where you are, whether you're an industry leader or someone trying to grow, you have different opportunities and different risks that present themselves. On top of that, we need to understand organizationally how a business is structured and financially how it's structured, and take that view and not just say, what's the company's debt service coverage, what's their debt service reserve, but we need to understand if financially and organizationally they're structured in a way that either exacerbates or reduces risks of the overall business. There's a ton of management techniques from a financial and organizational perspective that you can use in order to create a business that's stronger, because you've identified what your risks are and now you're taking steps to take care of that. And so that's something that's very important. If you're in a very cyclical business, you need to put a higher focus on accessible lines of credit, right? Committed credit facilities, long-term in nature, so that you can offset the cyclicality of your business. And if you do that properly, then when you hit a cyclical weak point and all of your competitors are seeing stress, you then have a lot of liquidity in order to take advantage of that. And then you can go out and come out as a stronger business and probably capture a lot more market share than you had going into that downturn. So strong management becomes very important. And that's really a foundation for how we do credit work. I think that in this environment, to your question, Laura, you asked, what are we favoring? We've actually shifted some of our portfolio towards utilities. This is a common thing when you end up seeing uncertainty or stressful markets where people shift towards utilities, but I think we do it a little differently. We don't think all utilities are created equal, right? So for an example, and I mean the equity guys would know about this company too, CU Inc. This isn't the CU that our equity counterparts can invest in, right? So when you think about them, they're probably more looking at something like a CU Limited or maybe an ATCO, I think is the ultimate parent. And
CU, Canadian Utilities?
Canadian Utilities, yeah. And so the importance of that is we can invest in CU Inc. We can also invest in the other parts of their structure, but CU Inc. is very unique because that structure is really Canadian, right? It owns 4 utilities, natural gas and electricity transmission and distribution in Alberta. We're very comfortable with the way those regulators have historically governed that market, right? That's a very great thing for a bondholder when you have comfort like that, right? Because again, it gives you more confidence in how that business is going to look tomorrow, right? If you look at different companies, they may have exposure to the US or something of that nature. This is entirely Canadian for that portion of the company. Conversely, when we look at something like Nova Scotia, Nova Scotia also obviously has electricity transmission, electricity power generation, but Nova Scotia Power gets almost 50%, a very large portion of their overall business mix from coal generation. Right? Now they want to get away from that, but we don't actually, what I'm talking about now isn't really about coal or whether coal is a good or bad thing. What's bad in this environment is that we're in a period of uncertainty that has come about from trade wars. So why would we not want to invest in coal generation in Nova Scotia? Well, because all of that coal is coming from the US. And so if you're going back and forth with trade disputes, then you potentially have no access to the main input for your fuel. You potentially have access at excessive costs. And so we're not saying either of those is the case, but if we're looking in this environment and trying to take risks out of the portfolio, for us, what we would try and strip out is potential adverse events from an announcement that could potentially all of a sudden shut off coal being delivered to your plants. And so that's the kind of protection we try and build into the portfolio. And in this type of environment, I would suggest something like a CU Inc. versus a Nova Scotia Power probably has a better framework for us if the spread is right, of course. Obviously, if you're getting compensated well enough to take on the risk, then you might favor Nova Scotia. But from a pure standpoint of potential risk popping up in this environment, we would lean towards CU Inc.
So we've talked about quality, alignment, credit discipline. Let's extend that to talk about discipline through different market cycles. In recent years, markets have rewarded growth and momentum. Brian, how do you maintain conviction in quality and value when the market favors other styles?
I think the cornerstone is always to maintain quality. That's got to be a very, very key thing, regardless of the investment environment that we're in right now. Okay. I think the thing that's changed rather dramatically in the past year is valuations. There's many sectors and specific companies where the valuation is almost, frankly, extremely high. There's almost a momentum that's happening in the marketplace in certain pockets. And so markets have gotten more expensive. One thing that we look at in Canada to do a sanity check on the marketplace is we always look at our fund versus the TSX. Now you can compare them on a variety of valuation measures, but I bring this one up, which is price to book, as one that historically has been interesting to use when things get extreme. And as a value manager, you would expect us to be less expensive than the market, and we've had periods where we've been traded at, one standard deviation deltas to the market. The interesting thing is that our discount, we have not changed fundamentally the quality of the companies that we invest in. The market has run, and it's run to a point where the difference between our book value and the market has gotten to 2 standard deviations. Now I'm going to ask a test question for those that remember Stats 101. 2 standard deviations. If you just count the tail, what percentage is that? Stephen, I'm looking at you. 2.5%. Bill, you bang on. 2.5%. So this is a period of extremes, at least within the context of Canada, the FGP fund, and the TSX. And we actually see this as an opportunity. We actually think that when you get to these discount ranges that are so wide, it's indicative of 2 things are going to happen. And it means that The market is a combination of very expensive and we're very inexpensive. And usually you gravitate. You don't know to what extent the market re-rates or we re-rate, but there's a mean convergence that happens. And so we've had a period of very strong returns in the TSX. Our funds have lagged the TSX a little bit, but we actually think that there's a really interesting opportunity right here because this is a rare event. So I think that the markets have been very, very strong. There are a lot of question marks and uncertainties that Ryan was speaking about. It's difficult to know what the future is going to be looking like, but from a pure valuation perspective, things have, at least in Canada, have gotten quite far ahead. And I was talking to a client just earlier before this presentation, and they were asking me, well, where do you think things go? And I mean, if you go back to statistics and you sort of say, well, in Canada at least, we've had 3 very strong years of returns, very strong. I mean, it's been great. Whenever I talk to my mother, I say, I've done a good job for you, Mom, but don't kind of expect this, super high double digits. She says, you're helping my RIF, which is fantastic. So I think we got to be cautious. And who knows? Who knows if there's a correction in 2 years or 1 year or tomorrow? I don't really know. But I am, in the sense that I look at statistics every day, and I do believe in statistics. I think this is an indication that we are well positioned. If the markets come down, we will be defensive. And I think that's really, really important to highlight. And it's not just, and when I say we, I say Foyston. Our firm is really based on this cornerstone that we want to protect our clients' capital. So as Ryan said earlier, we might miss something. We might miss that shiny thing that's done really, really well. But, clients want to protect the capital when things are not great. And so we've just put our 5-year downside capture for a few of your funds. And the blue lines you can see are us, and the yellow gold lines are the market, and you can see that we protect
the median universe.
The median universe, thank you. So I think this means that if things continue to do very well at least in the equity markets, we might not be as frothy as the equity markets, but that's okay. Mm-hmm. But if things don't go so well, and who knows what it is, but if things don't go so well, I feel comfortable that our strategies are going to protect clients' capital. And that is very important.
Thank you very much. Before we open it up to audience discussions, I'd like to quickly wrap up with a lightning round question, if you will. Brian and Ryan, at FGP, what is our edge? What do we see or do differently that gives us an edge in identifying opportunities that others might overlook?
I think we're pretty comfortable with our investment process. And so I don't think that in different market cycles that the changing dynamics make us give up on that. And I think you see a lot of investors over time give up on their bread and butter. And for us, we stick to our process regardless of what's going on in the economy or in the market, the financial markets in general. And so when you look at us and when you look at our, I'll mention fixed income in particular, that we're going to focus on companies that we understand, on companies that we can buy at good values. And, our focus isn't, again, on trying to add value this quarter. It's to making sure that we add value over the long term. And so we really stick to that process.
And yourself specifically and some other members of the fixed income team have a background, a credit rating agency background. So you guys are doing the work.
Yeah, I hope that's clear. A few of us do have credit rating backgrounds. Myself, I was there through the credit crisis. We do the credit work, and we invest in companies that we understand and that we can get comfortable with.
I'm going to pick up on that theme, which is when we do investments in fixed income or in equities, we want to add value. And what I mean by that is we're willing to look at the company, not just what it is today, but what is it going to be in the future? And sometimes you make an investment in a company, you want to buy high quality companies, but occasionally you get a company that might have a shorter term issue. I'm not going to give examples right now, but a very high quality company, as I described, good management, a predictable business model, good balance sheet, high returns on equity. But it's come down in valuation. Perhaps its growth has slowed down a little bit for a transient issue. And so we want to be able to look past what the consensus is maybe saying. We want to be independent in our viewpoint in analyzing a company. And that is what gives you an opportunity on the equity side to make a great investment. If you can buy a high quality asset at a reasonable valuation, and then maybe you're not 100% certain where things can improve, but there's various levers. That's a great investment opportunity. So you minimize the downside because you're buying it at the right price. You maximize the upside because you know what the catalysts are and you know how the business is going to evolve and how it's going to move on to the next cycle.
Excellent. Thank you both. Now, we'd love to hear from you and open it up to the floor for a couple audience questions. If anyone has one and wants to raise their hand. We answered everything that was on your minds. Bill, thank you.
Over the last couple of years, a good portion of the gain in the Toronto market has been driven by materials, as you've said, and gold in particular. How much of that run-up is gold, and what percentage of the index does gold represent, and how much gold do you have in your portfolio?
Yeah, okay, so three questions there. So I can tell you specifically on Q3 25, so the last quarter that we had, the materials index, and by the way, I'm going to give you approximates because I don't have the numbers right fresh in front of me, but the materials index was contributed to 12.5%, or pardon me, 5% of the 12.5% gain in the quarter alone. So 5 absolute of the 12.5. So if you strip that out, the TSX would have had single-digit gains. Of that, the materials component was up massively, like 35%. It was a huge number. So and that was largely driven by precious. Over the kind of the past year or so, materials have done very well and have been a big contributor. I don't know the exact index weight right now, but I would hazard to guess it would probably be around 10%, give or take around there. What is interesting though is my colleague Tom and I co-manage a resource and precious metals fund. We looked at the year to date at the end of September to look at the precious metal companies that had done particularly well. And I mean, honestly, it's staggering to see some companies are up 400% and even higher. And what was very interesting is that when Tom and I looked at it, and I'm going to give credit to Tom here for doing the digging on this, the vast majority of the companies didn't make any money, zero. So, and there was a ton of these, they were effectively speculative junior development companies that had just, that people are just throwing money at indiscriminately. So when we see this data, we look at it and say, okay, the fundamentals don't really justify this. It's pure speculation. So to your question, I think you're getting at, Bill, which is where's gold going? It's a difficult question to answer, but I'm going to take you back to how we think about basics about commodity pricing. Number one, commodities are all supply and demand driven. And so you have to look at the marginal producer in relation to the demand curve. And so right now, and Tom, correct me if I'm wrong here, but the most marginal producer in gold would probably be $2,000 an ounce, a little higher than that. And gold prices were recently above 4,000 and they've now come down below 4,000. So if you wanted to define it without, and maybe this doesn't sound too scientific, but the price of gold could easily go to 2,000. It's as simple as that, because that's where the marginal producer is. And so it's difficult to speculate, on these price movements. There's clearly some, demand drivers, but, central banks are buying gold and kind of starting to add more to their gold positions. But candidly, there is a lot of ETFs and passive instruments that are fundamentally indiscriminately buying these stocks, and it's having a ripple effect. So I'm not going to be so bold, especially being recorded, to predict where gold prices are going to be in a year's time. But I would hazard a guess that as long as that price trades at a material premium to the marginal cost, there's risk. The second thing too, and just taking a step back, if I may, material companies are risky to invest in as a general. When you have a commodity company, it is risky because your commodity gets repriced effectively, or could be, every day. Our philosophy in investing in a riskier space is to, first of all, look at materials that we understand the supply demand, and generally we prefer bulk materials as a rule of thumb. Bulk materials are consumed, they're necessary for industrial applications or consumption. So you can throw out things like potash, like copper, like zinc, oil, any of these things that are consumed for general economic growth. We like things that are consumed, and we like things that we can understand the demand. So that's the first thing. The second thing is that when you are in the material space, you want a company that has long life reserves, and generally within the bottom half of the cost curve as a rule of thumb. Long life means you don't have to spend a fortune to replace what you've just sold, and low cost means that if the price comes down, you're still making money. So that's defense against commodity cycles. The third thing is that you want a company that has a very sound balance sheet, because this material industries can be notorious for buying stuff and issuing equity. So we want really conservative balance sheet that can weather the storm, because commodities get priced every day. So we've generally not been invested in the gold companies directly, but we have been invested, I'm going to say almost a little bit on the sides that benefit from gold prices. So materials companies that we've owned in the fund is like Teck, for example, and copper and gold deposits are generally like that. And so when a copper producer mines copper, they get typically gold offsets, and they can use that to lower their cash cost. The second thing is a company like Teck actually has joint ventures with Newmont and with some other Canadian gold companies for deposits that are really gold deposits. They're more gold than copper. And even though the Teck is not a gold company, it has gold. And kind of the creative thinking that goes into investing sometimes is say, well, what if this was recognized as a gold company? What if we carved this out of Teck? Could this be recognized as a gold company? And the answer is potentially. Or would Newmont or Barrick or Agnico want to buy some of these things at inflated PNAVs and things like that? So we're sensible. And the other thing too is every commodity has its day, and then it doesn't. No commodity is perfect forever. So our philosophy when we invest in this risky space is to own diversified portfolios, companies that have diversified portfolios, either from a commodity perspective or a client perspective, geographically. So those are all kind of the calculus that goes into investing in this particular space.
So what I'm hearing is we don't need to own gold companies directly. Before we close, just a couple brief remarks. Thank you, Brian and Ryan, for sharing your insights. Thank you all for joining us today. I hope our discussion gave you a clearer sense not only of how we're navigating the markets, but who we are as a firm. And if something today sparked a question we didn't cover, please feel free to stick around after or reach out to myself or any of our team members, and we'd be happy to continue the conversation. Thank you all again for joining us, and we look forward to seeing you at the next session.
Thank you very much.